Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Bull versus Bear webinar on Wednesday, the 28th of September. Steve Miley on the call for trade day. Apologies, first of all, guys, for potentially, I don't even know what happened yesterday. I'm still trying to figure out. We never got to the bottom of it. For those of you who were on the webinar, I'm pretty sure Clinton, you were on. Anyone else was on the webinar yesterday? I'm pretty sure it started. I got to the end and I'm not sure what happened. I couldn't share it via social media. I couldn't find the recording of it. So I don't know what point it cut out. I continued to the end. I went on for like 25 minutes or something. I looked up and I couldn't tell. So did you get some of the webinar? Did it cut out halfway through? If you could just pop something in the chat, it would just be interesting to know. But I really have no idea what happened yesterday and couldn't get to the bottom of it. So if you could let me know, that would be useful. But my deepest apologies if it did cut off halfway through. Let's turn our attention, though, and get on looking for today. So, yeah, apologies if we're on the webinar yesterday and it cut out halfway through. I really have no idea. I still don't even know if it did cut out or not. So any feedback on that would be helpful. But I don't know what I'm going to do about it. Let's just hope it doesn't happen again today. Right. This is a chart that I just brought up. I'm going to come back to that chart because it is kind of what's really the main news on the overnight today. But let's go to the calendar first of all and see what we had. So, we've had Bank of England speaking this morning, but we'll talk a bit more about what they've come out and done this today. Surely, let's look a little bit ahead to what we've got coming up. So we do have retail inventories, not really big data in here out of the US, goods trade balance a minute an hour. These are really not big pieces of data by any stretch. Really maybe focus on the speakers in here, and we've got Powell later on. So we've got Bostic and Bullard, 8:35 Eastern, 10:10 for Bullard, 10:15 for Fed Chairman Powell. So keeping an eye out for those. Also Bowman speaking later, 11 a.m. In between there, you've got crude oil inventories day if you are trading oil at 10:30 Eastern time. So quite a few. We've got 3 Fed speakers plus Powell as well, so a total of 4. So that's going to be the flavour of the day today, watching what the Fed speakers have got to say. What have they got to add? There might be even a question about what's going on in the UK. So let's talk a little bit about that. I'll go to 5 things you need to know to start your day. So yields did surge yesterday and in the US and globally. Part of this is being driven by the UK move, okay? Global yields going higher. Good morning, Clinton. I just wanted to ask, I don't know if you heard at the beginning there, I was just asking, did the webinar cut off halfway? Were you on the webinar yesterday? It did start, I hope. I got to the end and I don't know what happened. So if anyone who was on you yesterday could give me a clue, just put it in the chat, please. Yield surging. So this is for various reasons. Obviously we're in a risk-off mode. Everything's selling off at the moment. Higher yields, fears about inflation pushing yields higher. Fears about more aggressive central banks pushing yields higher. The contagion impact from the surge in yields that we saw in the UK is certainly part of that driver as well. Sending global yields. What's happened in the UK has had knock-on effects into Europe and has knock-on effects into the US bond market as well. So we're seeing global yields pushing significantly higher. So the 10-year yield went above 4%. Nothing cut off. Okay, nothing cut off yesterday. Okay, that's good to hear. Thank you, Clinton. I got to the end and I couldn't share it. It didn't seem like it recorded. I don't know what happened there. So, okay, thank you for that. It seemed to be all going fine while I was in it. So yield surging higher is a big thing. Now they have turned around today, and they haven't picked it up in here because it's not breaking news. It happened a little while ago, but if I bring where is it? So risk trades cheer Bank of England announcement. So this came out like mid-morning my time, so very early if you're in the US. And so basically the Bank of England announced in here. So if I bring up this tab in here, Bank of England announcement and to carry out temporary purchase of long-dated UK government bonds. So remember, they've been tempering the purchases. We've been doing a quantitative tightening, but they're actually coming back in. So that's like a quantitative easing, right? And they're back in buying long-dated UK government bonds. And that's obviously pushed bonds back higher in price, lower in yield, okay? So, and back to QE. Well, sort of. Here we go. Gilt yields have fallen on the announcement. 10-year yields now down 4 to 4.3 from about 4.55. So I did bring up, you saw it probably at the beginning here, we've got the UK government yields. So we've had this surge since last week, right? A surge in government yields from like 320 to 460, above 460 we were at one point today, right? A massive move. This is 10-year government bonds, okay? And this is all on the back of what they did, the government did. I mean, they were pushing higher even ahead of the government, okay? And the government announcing this mini budget. They were even pushing higher from Thursday, but then Friday and through the beginning of this week, an absolute aggressive, super aggressive push higher in yields. Panic setting in that the Bank of England are going to have to raise rates aggressively. One, to protect the pound, and two, to basically counter what the government's doing. It's like one hand not talking to the other hand, right? And obviously they're independent. The Bank of England does what it wants, and and it's been independent for a long time. But there is a real problem here. The Bank of England is obviously trying to slow down inflation, slow down the economy without causing a recession. And then the government comes out and does massive tax cuts, tax hikes, tax raises that were in the pipeline. They scrapped those and got an increase in government spending, which is probably the socially right thing to do because of trying to cap energy bills. Okay. But then to also give big tax cuts away, the markets we know didn't like this. I've covered this repeatedly over the last few days, since Friday through this week. And the markets didn't like it. The pound smashed to an all-time low against the dollar. The pound going down, not just against the dollar though, against all currencies, against emerging market currencies. It's moving to like record levels against the Chinese currency, against European currencies, against the euro, etc., etc. The pound got smashed against everything on the back of this, and the market's clearly showing that they're not happy. They're not happy with what the government are doing. They don't believe that it's sustainable. They don't believe it's the right thing to do. So the Bank of England have come in and kind of tried to save the day, but doing what they can. So, Bank of England to carry out temporary bond purchases, as I say here. This is a site I don't come to probably enough and share on the webinar. I do use it myself. Forexlive.com is an excellent site. So this is all run by ex-traders, ex-brokers, ex-analysts from the market who are now got their own independent site. Do a really good job of covering. It's 24 hours. They cover Asia through Europe and through the US sessions, and so you get and different coverage from different people with different expertise. So you get all sorts of stuff in here. You get news announcements, you get rumors, you get stuff on technicals, you get all sorts of stuff in here. It's got a more of a forex focus, but it does cover everything else. So it will look at bond markets, it will look at equity markets as well. So I would recommend this site. It's a great little one-stop shop to kind of just get up to speed of what's been going on. So they're covering this. So this morning they've done a good job of covering this. So risk trades cheer Bank of England. So we have had a rebound in riskier assets, right? So basically bond markets went to, as I say, UK bond market in here, having been accelerating higher in yield, went back down, lower in yield. So bonds, this is bonds going up in price, right? So this is UK 10-year bonds. They're called gilts. Okay, so two UK 10-year gilts going high. And if we look at very quickly what's happened in the Treasury market, Treasury has obviously been plunging lower in here. This is the Treasury price. Okay, this is the Treasury market, the futures market, and then this morning went lower as well, but then rebound. We've seen this rebound, and they're rebounding with the gilts rebounding as well. So it's a move to higher price, lower yields on Treasuries as well, getting some respite and getting help from that. So that's why we've seen this move, and that's why then risk trades have done slightly better. So as it says in here, I think on one of these in here, so stocks pull off 2020 lows. Okay, Bank of England steps into commodity. So we've seen a rebound in European and US stock futures, having gone lower in here this morning. So we go and take a look of what's happening here with European markets. With Bloomberg, we are still down. Okay, we're down this morning, and this Nord Stream thing has not helped matters either. So in here, we'll talk about that in shortly. But we're down in here. Look, so we've got it bourses this morning 1 to 2% down in here. Okay, but FTSE 100, you can see 0.58 is actually rebounded. These stocks indices have rebounded off their lows, and that's been helped by this Bank of England move. So that's definitely seen as a positive. But one part of the reason they're down is this Nord Stream sabotage. Sweden saying it's not an attack, but there's been sabotage to these pipelines. We said yesterday on the call there's been this 3 pipelines got damaged, right? Allegedly damaged. Well, there's actually been sabotage. Where's that come from? We don't know. We can only speculate. I don't want to say what the speculation is, but you can probably guess what the speculation is, right? So cutting off supplies, gas supplies to Europe, and that's seen gas prices obviously spike back higher. The gas prices in Europe have been coming down slowly more recently, but spiking back higher. So that's not helping matters whatsoever. So a big focus on this Bank of England here. So sterling, even though bond yields have gone back to higher prices, UK bond yields and lower yields, okay, it hasn't helped the pound. And the pound you can see in here, I'll just pop this chart out, as plunging back low again. Initially spiked higher. Okay, so this was the big sell-off that we saw earlier in the week on an Asian time when the market collapsed to an all-time low below 104, right? It then subsequently rebounded and then been consolidating, but you can see spiked higher on the Bank of England news, but then back lower. The pound doesn't like it. So the pound back lower in here, still echoing ongoing concerns about the whole situation we have here in the UK. So look, will the Bank of England band-aid work? Really good little quote in here. It's mental to think that the Bank of England has had to take such an intervention based on a reaction to government policy and not an external shock. Yeah, I mean, it is, it's like, as I said, one hand not listening to the other hand. We've got basically the Bank of England trying to undo what the government has done. Sometimes, central banks have to step in when there's something big happening externally, right? COVID, etc., that kind of stuff, but not when it's being generated internally. So that's not a good situation. So, but nevertheless, will the band-aid work? Well, the pound's telling us it's not going to work in the long run, right? So that's not good. Okay, so that's kind of been the big breaking news in here this morning. Okay, and it has had a pack. I know you guys are thinking, well, why is he talking about the UK? Why is he talking about the gilt market? I'm trading the S&P. I don't give a crap about the gilt market, right? Well, you know what? It's had an impact here on the Treasury market. Treasuries are definitely bounced on the back of that. And if it's had an impact here on the Treasury market, it's going to have knock-on effects into the markets that you guys are trading. And we have seen, if we come in here, say, for example, on the NASDAQ, even though it's still down, yeah, it's bounced off the lows, okay, and that's being helped in here. This is when the UK government announcement came, right? This rebound here, this is where it come from. This rebound, okay. So just to let you know, that's what's been going on, just to broaden and give you a better, broader knowledge and understanding, okay. So Treasury yields parries advance after rising to 2008 high. Yeah, so that's what we just talked about, right? Treasury index is heading for its worst year since 1970. Yeah, I think yesterday I said, UK gilts are down 27%. They've wiped off 27% so far this year. Okay, and UK long bond set for record rally after Bank of England. So this rally is helping the fact the Treasury is coming off. They're parrying their yield advance or their sell-off. Okay, which is that what we just looked at just now on the charts. However, the dollar continues to climb. So if we go in here and take a look back at the US dollar index over here, where do I have that? So you see in here the US dollar index. I'll just pop this out. It's gone to another high, dipped and rebound yesterday, another new high in here this morning and staying strong. So, and that's being helped obviously by the fact that the pound is selling off versus the dollar. That's part of the equation that goes in there. And if we take a look at the FX board across the board in here today, pounds down over 1%, 1.3%, euros down a third of a percent, the Australian dollar's down like 0.45%, dollar yen is flat in here on the day. So the pound weakness, infecting the euro, so the euro going low against the dollar as well. Risk currencies down as well because of the sell-off that we saw in stocks and earlier on today and from yesterday, and all of that adding in to dollar strength. Okay, right. So let me go back to some of the in here. So dollar strength was spoken about. The Chinese yuan is falling to its weakest since 2008. That's dollar strength as well. But also PBOC's reference rate is smallest in 2 weeks. Okay, so so offshore yuan falling as well. So again, dollar strong across the board. And again, look, UK long bond poised for a record rally on. So this was a record rally on the day, but having come from a very, very negative position. What else do I have in here? So indices, so we've spoken about the European indices. Let's take a look at what the US indices have done in here. So we know lower. So incidentally, US mortgage rates, interest rates above 6.5%, highest since 2008. Okay, as well. So again, they hit those kind of levels. And if we go and take a look at where we are going into today, So we were down. Dow was only like 4 tenths. The Nasdaq and the S&P hitting. The S&P pushed down through that yesterday, through the low of the year, the June low. We'd already closed at a new low. We actually then hit a new intraday low yesterday. But if we look in here this morning, we're still down. Even though we've bounced off the lows, we're still down. And the Nasdaq getting hit on the fact that we've gone to even higher yield, lower treasury prices, higher treasury yields, particularly impacting the Nasdaq. There was also news out of Apple, which is really damaged as well. So Apple drops plans to boost iPhone production as demand falters. So this as well impacting in. Okay, so part of this impact in here of the Nasdaq. Why is the Nasdaq down 1% with the S&P in here? So the Nasdaq has been a bit outperforming recently, but if we go in here, we see look, we're down like 0.5%. Nasdaq's down nearly 1% in here this morning. That is being also driven by one, the higher yields, but two, this Apple news. Okay, and Apple's gapped lower in here this morning. Quentin, question from Clinton. So is dollar strength suppressing US market as odds with the boost from UK policies, creating a probable sideways to lower market conditions here? Partly, I mean, obviously, a stronger dollar actually then is a dollar strength is negative for the US markets. Obviously, a stronger dollar has a negative impact onto US indices, and so. Yeah, I mean, I think it's going to be tricky going into this morning. We'll come to the chart shortly, but the bias is still down. New low on S&P, broke the 2022 low yesterday. Even though we've had a bit of a rebound, I think it's a brief respite. Being driven by that acting. You have it's more than the dollar strength. I think it's more that the knock on from the Treasury market. So you've got basically Treasuries were going to higher yields, and they have come off of those higher yields because of the Bank of England, because UK markets have come back from those high yield levels. Okay, so that's allowed US treasuries to come off those high yield levels, but they're still kind of up, right? They're still looking quite aggressively higher in yield, which is going to weigh on the indices today. So I still think, even though we've had a turnaround, it's not been enough. Okay, so and then dollar strength obviously doesn't help the US indices either. So for me, technically, I would just be looking at them independently, but the makeup, even though there might be a bit of a respite from the rebound in treasuries, I don't think it's going to be enough. Unless treasuries, we go back to the treasury chart. If you want to look at a chart, I wouldn't necessarily be looking at the dollar in here, Clinton. If you want to look at another chart and say, monitor, are we going to get a shift around? It's going to be this one, right? And you can see, even though we're off so this is the treasury futures, right? The 10-year. Even though it's bounced off the low in here, I mean, it's like dead cat, right? It did bounce. If I step in now, and go to shorter time frame, if I go to, I don't know, a 15-minute, yeah, I mean, it did. There's the rebound, and that did come from that news, right? This has come from the announcement, right? So that is being driven. If you went and looked at the gilt chart, the gilt chart would be at the same time. This was driven by the Bank of England announcement. But look, you've given back up nearly over half of it, right? You've given up nearly half of it. Over half of it, sorry. So, with all the pressure is back down lower in yield. So if we go back to the daily, you can't say that looks bullish, that chart there, right? That is not a bullish chart, right? It's still very, very negative. So if anything, what would need to turn around is, and then, okay, so we get this knee-jerk reaction. So again, going back to the short-term chart, you get this knee-jerk reaction to the Bank of England move from the treasuries, and then they dismiss it. All the focus is now going to go back onto treasury market, going to go back onto the Fed speakers, the 4 Fed speakers we have today, onto Powell. It's going to become US centric again. If we were up here and we'd held up here, right, then I think it would have more of an impact, right? If we go back to the daily, if we were sitting up here, yeah, right at the top of this bar from today, and it could attack yesterday's high, then I would say, then there's a real risk that then this turns around, and this turns around, that's going to give NASDAQ a boost, particularly to the upside, and the rest of the indices as well. However, we're a long way from that. I mean, I think unless, you basically need to get one above today's high on treasuries to make a difference, and then certainly then really above yesterday's high. Okay, so those are the trigger points I would be watching, Clinton. If you want to watch another market somewhere else, that's going to turn this out around and give a more positive positive tone to the indices, those peaks there, I mean, those will be my triggers, and just simply, you just step in and just look at the highs. It's going to be that spike high up there. And if you want to get a heads up, you start doing a bit of analysis on here, right, as well. And it's going to be it's going to look similar to the other charts. So if we go now, I've kind of covered most of what I want to, but Apple is weighing as well, so that's not helping matters as well. What else do I have in here? Anything? Mini budget. So this is going back to the UK. Mini budget, major turmoil. That's looking back to Friday, really, though. Bank of England seeks to stem market turmoil. Yeah, this is all the same stuff, but coming out. Dollar marches to new high. All the same stuff we just looked at from Bloomberg, but this is now looking. And I don't think there's anything in here we haven't covered. Apple production, so Apple falling. We've spoken about that. This stuff you going on with Ukraine is not that important. Dollar, another record high in here. We've already spoken about that. Okay, let's go take a look at some of the charts. And I think, just drill into where we are. So if we go and take a look at the daily on the S&P, obviously we eclipsed, we went down through that June low, we closed at a new low, and then even lower in here this morning, but we have bounced off the lows. Okay, so if we go and take a look at the S&P, but the bounce, and that was helped. So there's the same move, right? There's the move helped by the Bank of England. Okay. However, you know what? No respite. It's come back lower. We've given back. If you want to put your fibs on this, right? You're halfway back. You're halfway back from the low to the high in here, and pushing lower. So I think this is dead cat bounce. For me, it's all being approached from the downside. You got this little low in here that we've had just in the last 30 minutes. Where's that? We are 36.32 and 3/4 down through there, and then you're aiming at the back to the low. It's got to minimally get above these spike peaks, and then you've been monitoring these and those treasury levels. These peaks in here, we didn't even manage to get above these overnight peaks. Okay, so on this Bank of England news, so the high there is 36.65 and a quarter, and then you've got 36. 74 and 3/4. Those would be my trigger words. If you can get above that higher one, then you know what? Yeah, potentially. And then again, watching the treasuries. If treasuries start taking out those resistance levels before these levels, you can bet these levels are going to go as well. So you can get earlier triggers maybe from the treasury markets. And if we go and take a look at the Nasdaq, and Nasdaq a much poorer performance. We're down through. We're sitting. We're not actually through the low in here, I don't think. So low here is 11,135, low here. Maybe we just pipped it. No, 11,141. We just held the June low. Okay, just held the June low. 135 is the June low, 141.5. But if we step back in again, right, dead cat bounce. There's the move back higher, the respite. But you've given back. I can put the fib on, but it's not rocket science to be able to see that we're halfway. You're through halfway. You're through 61.8 as well, right? So you're through, all the major retracements in here. And again, if you want to have a deeper look, I'd say, if it gets back below the low from 30 minutes ago, it's going to attack this low. And then if it's going to attack that low, this morning's low, it's going to then go and have a look at 135, which is the June low. And that could see, more aggressive stop running and that kind of stuff. So the current low from the last hour has been 192 and a quarter. So, watching out for that. Top side, it's got to get back above there and then back above there, right? So the overnight peak, this spike high from the Bank of England, 311 and 3/4. Okay. So those are kind of my parameters. I'm going to wrap it there, guys. Okay. It's still looking bearish for me. We're still in risk off. We've had a brief respite from this Bank of England intervention. It hasn't done enough to stem the more negativity. Clearly, anything we get from the Fed speakers could change all that. So watching out for those Fed speakers, Powell in particular, but watching all those Fed speakers today. Remember to go to the ITC as well. Remember this in here. I'll share it in the. Remember, if you haven't bookmarked this, you should bookmark this. Or if you don't know your Fed speakers that well, come in here. This cheat sheet in here, Dove cheat sheet. Okay, and it's whether these, if a hawk says something hawkish, it means nothing, right? If a dove says something dovish, it means nothing. It's when the hawks say something dovish or the dove says something hawkish. So know where your Fed speakers are, which part of the spectrum of hawk dove they are, and see if their speeches are hawkish or dovish, and then you can get an idea of what kind of reaction we can get from the markets on anything they might say. All right, guys, I'm going to wrap. Have a great trading day. I'll be back with you with another webinar tomorrow. Until then, take care and stay safe. Bye.